Hello everyone, I am Sudip Chakraborty and I am a teacher, trainer, entrepreneur and a YouTuber. Today I am going to discuss about capital and revenue expenditure. And by the end of this podcast, I am sure you will be able to differentiate between the two and also have a clear idea about its treatment in the final accounts. So let's start. As we know, the accounting process starts with journal and ends with final accounts. Final accounts is prepared from trial balance and it is further divided into income statement and position statement. Income statement reveals the profitability of the business, whereas position statement reveals the position of assets and liabilities on a particular date. Income statement consists of trading and profit and loss account, and position statement consists of balance sheet. The classification of expenditure into capital and revenue is important because the treatment of both the expenditure is different in final accounts. Capital expenditure is added to the cost of the fixed asset to which it is related, and it is then directly recorded in the asset side of balance sheet, whereas revenue expenditure is treated as regular expenditure and it is recorded in the debit side of trading account or profit and loss account. If proper treatment of capital and revenue expenditure is not done, then it will affect the profitability of the business. Now the question is how to identify which one is capital expenditure and which one is revenue expenditure. It's quite simple actually. Capital expenditure has the following features. Number 1, it is the amount spent on acquisition or creation of a fixed asset. For example, amount spent on purchase of a machinery or creation of a furniture. Number 2, it gives benefits for more than one accounting period. Number 3, it helps in bringing the asset into working condition. For example, installation cost. Number 4, it adds value to the business by increasing the earning capacity and productivity of the business. For example, any amount spent on upgradation of any machinery. And most importantly, this expenditure is non-recurring in nature, which means this expenditure is not incurred on a regular basis. Now on the other hand, revenue expenditure has the following features. Number 1, it is incurred for the day-to-day running of the business. For example, payment of salaries, rent, electricity bill, etc. It is incurred to maintain the fixed assets in proper working condition. Example, repair cost, maintenance cost, and so on. Number 3, it is incurred on purchase of goods during the year. Number 4, it can also be in the form of non-cash expenses such as depreciation and amortization. And most importantly, it is recurring in nature, which means this expenditure is incurred on a regular basis. Now, let's talk about certain exceptional situations. There are certain items which appear to be revenue expenditure but are actually treated as capital expenditure. So what are those items? Number 1, wages. Normally wages paid is a revenue expenditure, but when wages are paid for installation of a fixed asset, then such wages are treated as capital expenditure and it is added to the cost of the asset. Even wages paid for construction of a new building for the office, for the company, or for the manufacturing, for the creation of a new machinery, for construction of a new machinery is also treated as capital expenditure. Number 2, repairs. Amount spent on repairs is again a revenue expenditure. But suppose a company buys a second-hand machinery and the amount of repairs spent on it for the overhauling of the machine to upgrade the machine will be treated as capital expenditure instead of revenue expenditure. That amount will be added to the cost of the machine. Third one, legal expenses. Usually legal expenses incurred is treated as revenue expenditure, but any legal expenses incurred in relation to purchase of a fixed asset or acquisition of a fixed asset is treated as capital expenditure and is added to the cost of the asset. Next one, transportation cost. Any transportation cost spent while purchasing an asset is treated as capital expenditure and again is added to the cost of the asset. And lastly, raw materials. Raw materials used in the construction or making of a fixed asset is again treated as a capital expenditure instead of revenue expenditure. So now let's talk about deferred revenue expenditure. Deferred revenue expenditure has the qualities of both capital as well as revenue expenditure. It is an expenditure of revenue nature in the current accounting period, incurred in the current accounting period, but the benefit of this expenditure will be derived by the business for more than one accounting period. We know revenue expenditure gives us benefit for up to one accounting period. The benefits of revenue expenditure does not go beyond one accounting period. But in case of deferred revenue expenditure, the benefits are derived for more than one accounting period. And one more thing is, it involves huge amount. Deferred revenue expenditure involves huge amount. And for that reason, it is written off over a period of time, say 3, 4 or 5 years. The reason is that since this expenditure provides long-term benefit, it is logical to write it off over a period of time. And moreover, this expenditure involves huge amount. So therefore, if the entire amount is charged in 1 year, then company's overall profitability might get affected. So it is better to spread the amount over a period of time and write it off gradually over a period of time. So now the question is how it is written off. Let us take an example. Suppose a company spends rupees 1 lakh on advertisement, which will give the benefits for more than one accounting period, say 5 years. So the company spends rupees 1 lakh on advertisement, and company is expecting to derive benefits out of this advertisement expenditure for at least 5 years. So this is your example of deferred revenue expenditure. So the company decides to write it off over a period of 5 years. So how it will be done? Let us understand. In the first year, rupees 20,000 will be charged to PL account on the debit side of PL account, and in the balance sheet, deferred revenue expenditure will show a balance of 80,000. That is 1 lakh minus 20,000, 80,000. In the second year, again PL account will be charged with 20,000, and in the balance sheet, deferred revenue expenditure will show a balance of 60,000. That is 80,000 minus 20,000. In the third year, again rupees 20,000 will be charged from PL account, and the balance sheet deferred revenue expenditure will show 40,000. In the fourth year, again 20,000 will be charged in the PL account, and deferred revenue expenditure will show a balance of 20,000. And in the final year, that is fifth year, PL account will show again PL account rupees 20,000 will be charged, and in the balance sheet the deferred revenue balance is now 0. So it will not be shown because it has been completely written off. Now the thing is how it will appear in the balance sheet. We know it will appear in the balance sheet, but under which head? It will appear under asset side. It will appear under the head assets. Okay, but as which asset? It will appear as fictitious asset. Since this is not your current asset, since this is not your fixed asset, this will appear as fictitious asset. That means this is not your actual asset. Fictitious assets are not actually your assets. Okay, fictitious assets, as we know, these are not your actual assets. So deferred revenue expenditure is not our actual asset. So we treat it as fictitious asset, and we have we record it in the balance sheet as a fictitious asset over a period of time till it is written off completely. And once it is written off completely, it will not be shown in the balance sheet. So this was all about the concept of capital and revenue expenditure and deferred revenue expenditure. In my next podcast, I'll discuss about capital receipts and revenue receipts, as well as capital and revenue losses. For more such podcasts and videos, follow me on Twitter, Instagram and Facebook, and subscribe my channel on YouTube. And if you want to join my online classes, then you can send a message on my WhatsApp number, that is 9658 751 229. See you next time. Thank you and bye.